I'm good. It's going to pop up in just a second. Live. Where's the Zoom camera? And do you see me and the PowerPoint?
Not yet, but you could take a second.
No, there's something wrong. Let me fix it. Okay. Okay, so
There you go. Happening now live. Okay.
there we go. And we can see. Okay, this is as far as I'm going to be able to move this thing forward. Oh, let's go back. All right.
All right, Steve, I'm in.
Okay. Yeah. Let's see. Cool. Oh. Okay. Let's see. Let's get started in about a minute. Well, hello and welcome to Facebook Live. We're here at Retire Smart Magazine. My name is Steve Sexton. It's been an honor to be able to provide this information in this live Facebook Live event. Today we're going to be talking about taxes in retirement. It's pretty interesting. I find when I speak with people about taxes, it's a lot like quarantining. You have some people, they love just staying at home. They're with the family. Everything works really, really, really well, and they all get along great. Well, I'm on that second track, that second track where your wife realizes that you have phone calls at 4 and 5 and 6 in the morning. So she scoots you off to the office. I spent my whole quarantine in my office because it was better for mental stability in our household so everybody else can sleep. So you kind of get that. Now, when it comes to taxes, I also find that people are on two different tracks. I've met people for the last 20 years that'll come into my office. They've actually figured out exactly how much they're going to pay, exactly how much they're going to get back for a refund, and they go ahead and pay for it. They don't think twice after that. And then I have others. These others, they look at their taxes as, how can I reduce and eliminate taxes each and every year so I don't have to pay any more red cent than I have to the federal government. Now, you can always pay for more if you like, especially if you love what the federal government is doing. So today we're going to be talking about taxes, okay? Now, one of the things that you all will be receiving at the end of this event is the white paper on how to prepare for the next recession. It's a wonderful piece of information. So make sure everybody has your email, so we'll send it to you, no obligation or anything. Sometimes when we go through things, it's important to understand this. Retirement planning is a comprehensive, I'm going to say sport for the lack of a better word. It needs to be holistic. So if you make a change to taxes, it could affect your income, your assets, the amount of money you give off to somebody you love and care about, and it could affect the ability for you to fund healthcare issues if you do them improperly. So it's important to understand, hey, I'm going to show you a number of things today. I'm going to teach something that you could learn and maybe implement, but make sure you speak with an advisor, a tax professional, or an attorney before you do that, just to make sure it's done properly. Every once in a while I have somebody that tries to implement something and they forget one of the little details, or hey, in a 20-minute webinar, we don't go through all the details, and it doesn't work out the way they want. And we have to fix it. We don't want that to occur. So make sure you talk to a professional. That being said, Retire Smart Magazine asked that if I would give 5, 10, 15 minutes to anybody who had some questions or wanted to learn how to apply what we're talking about today to their own situation. And we do that through what's called a discovery call. You can go to the Facebook page or the Retire Smart magazine, and you know what? You can sign up on one of those 15-minute discovery calls. All we're going to do is we're going to answer your questions and help you apply what we've taught here in this Facebook Live event to your personal situation. So let's get started. Now, tax preparing versus tax planning. A lot of people get this confused. Let's just clear it up right up front. When you talk about tax preparing, that's when you bring your bag of information, your folder of information, your thumb drive full of information to your tax professional. They're going to try to put all the right information in all the right boxes. They might be asking you things like, hey, did you donate to the charity? Did you buy something big like a car so we can write off the taxes you paid? That's tax preparing. Tax planning is about putting together a plan that helps you lower and eliminate your taxes on a consistent and ongoing basis. Okay, so again, you want to make sure you have a discussion with your tax professional before you move forward, as well as your financial professional, because you don't want to make a move and find out it doesn't benefit the way you thought. Okay, so first question. Let's think about this. I'm going to ask it rhetorically, but where do you think taxes are going to go in the next 5 to 10 years? Do you think they're going to stay the same, go down, or go up? We've done online polling before. In fact, we do this pretty much every time I do a tax event. And in the last 5 tax events, the polling online shows that 98% of people expect taxes to go up in the next 5 to 10 years. You know what? So let's take a look at why I agree with that segment or that sentiment. So first of all, I'm going to bring you through a little bit of tax history. So if you take a look at this, the red line is national debt. The blue line is top tax brackets. I'm going to bring it way back to 1914, almost 100 years ago, a little more than that. National debt was just under $3 billion. Top tax bracket was 7%. Okay, let's move forward to 1944. We're here almost at the end of World War II. National debt was just over $200 billion. You got to remember, I'm dealing with the billion word, not the trillion yet. And you know what? The top tax rate back then was 94%. Now I'm going to fast forward to September of 2019. Top tax bracket, as you know, is 37%. In September, which is the end of the U.S.'s fiscal year, the top national debt was $22.7 trillion. Now, between September of 2017 and May of 2020, we added almost $3 trillion in national debt because of the CARES Act, and the payments are being made to supplement the economy to make sure it grows. You know what? And if we have another stimulus, that's even going to go a little higher. Now you've got to remember, that's a lot of debt. We have over $200 trillion in unfunded liabilities between unemployment, Social Security, not Social Security, but Medicare and Medicaid. If you take a look at Social Security, according to the trust fund last year, you know what? They were going to run out of money in 2035. But according to the bipartisan budget committee, they've found out or projected that after 2020, the Social Security trust fund will run out of money by 2029. That's just in 9 years. Now, if we go to our fair state of California, we've already heard Governor Newsom say that they're going to be short $54 billion this year. So here's the question. Real simple questions like, are we likely to significantly reduce our national spending? Okay, if you think about that, what are the options politicians have? They either increase their spending, and if they don't increase their spending, hey, maybe they can cut the budget that way. But if they don't decrease their spending, the only option is to raise taxes. In fact, prior to, in our last primary, In my area, there was over 13 counties that were looking at increasing taxes, and 12 of the 13 didn't pass, but you can see how the legislature is pushing those additional taxes. And then, hey, what effect will it have on your retirement accounts? So let's think about that for a second. You're in a 10% tax bracket. What if it goes to 20? What if you're in a 12 and it goes to 22, or 24 goes to 35? How will it impact your income in retirement? What will it do to your ability to travel, take care of emergencies, things like that? The reality of this, we are likely to see significant taxes moving forward, and based off all the polling and the surveys that are done, most people believe that. So it's really important to start thinking about how you can lower or eliminate taxes moving forward. Now, got to remember, Tax Cuts and Jobs Act's going to sunset in 2026. Now, I don't know when taxes will go up. Could be next year. Could be 5 years from now. So we'll have to see. Now, let's talk about tax strategies. The reality, there's only really three major tax strategies: tax deferred, taxable, and tax free. So if you take a look at the tax deferred strategies, it's important to understand these are all the IRAs, 401ks, 403bs, 457s, pensions, and profit sharing. Let's understand how these accounts were funded. First of all, while you're working, you contributed money on a tax deferred basis, which means at the time you didn't pay taxes. And while you had them in that account, you earned interest on top of the interest that you're earning, on top of the money you should have been paying taxes. Plus, if your corporation was matching your contribution, oh, it's a great situation. In fact, you had more than a triple compound there. But the issue is when you have to start taking out money, either when you're in retirement or at least by the age of 72 when you have to take your required minimum distribution, you're now going to have your largest tax asset be taxed at your highest tax rate. And if you pass away and it doesn't transfer over to your spouse, it goes off to one of your kids, they have to take it out within a 10-year period of time. They can take it out in a lump sum, a little bit at a time, but think about it. I have $1 million that people are going to have to take out over the next 10 years. If you add in the increases in value or growth with it, they'll probably have to take out anywhere from $110,000 to $120,000 to dispose of it or withdraw it all within 10 years. If you add another $100,000 of income or 80 or whatever, you're looking at somebody paying 40% on that. It's a time bomb, folks. Now, let's look at taxable. We have things like stocks, bonds, savings, CDs, mutual funds. Let's take CDs, for example. You know what? You're earning what? 1.87 to 2% right now? You got to pay taxes, you add inflation. In an account like that, you're basically losing money safely. In fact, we call CDs certificates of depreciation. But one of the important things about taxable accounts is things like, how are things taxed? So if you have bond income, savings, CD income, and some mutual fund income, you'll pay ordinary taxation on that, taxes at ordinary rates. With stocks and certain types of dividends, you will pay capital gains rates, which cap out at 15%, and also give some benefits because if you're in a 10 or 12% tax bracket, you'll pay zero. So it's important to understand how things are taxed. Now, the last one is the tax-free corner. Now, what's really interesting about this, you see the very first one's a Roth IRA. That is by far the most popularly well-known tax-free strategy. What's interesting is most people don't know all the little nuances like, your conversion, partial conversion, recharacterization, the strategies for mitigating the upfront taxation that goes along with it. In addition to that, other things that are tax-free is health savings account, municipal bonds. They're federally and state tax-free, providing you live in the state where the bond is. Now, if you're in the state of California, you've got to make sure you look at the city and the municipality or the county as well as the state to make sure your bond isn't going to default because it's going to be based off those entities' fiscal health. We also see cash value life insurance. A lot of people use the cash value in life insurance to take tax-free withdrawals for income throughout their life. There's also 529 programs, as well as the last one is your primary resident. And that's about it. Now, the moral of this story, and it came from one of my mentors, and this mentor said, Steve, it's just as important to diversify your tax allocation as it is to diversify your investment allocation. And I keep wondering to myself why, and I realize it was actually more important. So let me give you an example. I have a client that has $400,000 in gain in her 3M stock. She's just had it for a really long time. She's not liking the way 3M's going, and she's asked her broker to sell it. Now, when she gets hit with a $400,000 gain, she's going to have to pay capital gains tax at 20%, not 15%. Net investment tax, or you might know it as the Obamacare tax, at 3.8%. State tax is at 13.3%, so she's stuck with 38% of that. So if you think about it, instead of netting $400,000 in a gain, she's going to net about $220,000. See, the moral of the story here is after you sell the investment, you've got to pay taxes. That is your real rate of return there. So let's kind of see what's possible. Here's an example. Everybody who's interested in a Roth conversion and what it means to them. And again, I want to make sure everybody's clear. There's a lot of people that want to do Roth conversions. You just want to make sure down the road you're going to have enough income to support your lifestyle if you need it for health issues. And to make sure, or if it's important to you, to make sure you have enough money to go off to the ones you love. So let's give you an example. 65-year-old couple. In 2017, they were in a 15 bracket. Their goal was to convert $200,000 to an IRA, to a Roth. So if they did it in 2017, they would have paid $56,000 in tax. If they do it now, they'll pay $44,000 in tax. So that's a 20% savings. So what does that tell you nowadays, folks? Taxes are on sale. So if you're going to make plans, do it while the sun shines, because you're going to have an opportunity to save yourself some money. Now, most tax planning, you want to do things over time. You just don't always do it all at once because it might be too destructive to your financial plan. So let's take a look at an example. Let's kind of see what's possible. Understanding the difference between ordinary versus qualified dividends. Ordinary dividends are taxed at ordinary tax rates. So I have an example. Somebody has $25,000 in ordinary dividends, capital gains, and Social Security. It's an $80,000 income. Because of the way things are taxed, they're not going to pay. They're going to have up to 85% of their Social Security tax. But because of the way the capital gains are taxed at ordinary income, you can see they're paying about $1,700 in taxes between federal and state. But if they were focusing on qualified dividends, which means there's certain requirements that you have to qualify for in order to identify as qualified dividends, same income, but because qualified dividends are treated just the same as capital gains, meaning if you're in a 10 or 12% tax bracket, you have zero taxes on those items. So their total taxes went from $1,700 to $26. I bet that's pretty interesting, isn't it? So the key here is to understand how everything's taxed and what it means to you. Now I want to show you something. About 8 years ago, I started working with a couple. They were expecting to have about $120,000 worth of income. And you know what? In their current state 8 years ago, they were looking at, I rounded these numbers, about $35,000 Social Security. They had the ordinary dividends, IRA distributions. They had a real estate investment trust that $10,000 was taxable, and they had capital gains. Okay? You could see here that their taxation was $11,897, almost $12,000 a year. So let's take a look at this. One of the things that we did over the last 7-8 years is we slowly but surely made sure we utilize qualified dividends. Instead of making IRA contributions, we overfunded a life insurance policy that created a $30,000 a year tax-free income, and this will occur on a tax-adjusted basis for the rest of their life. We started converting IRAs to Roth IRAs, and we're able to take a $10,000 tax-free income, a $30,000 tax-free income. So you know what? We're back to that $80,000. But in this scenario, they're only paying $348 in state taxes. Now, I know a $1,700 savings is interesting, but a $12,000, almost a $12,000 savings kind of gets pretty sexy now, doesn't it? Think about this. You're saving almost $12,000 a year for 10 years, $120,000. If you do this between the ages of 64 and 84, that's $250,000 that you have to go travel, do things for the ones you love, 529 programs, pass off more to the people that you love and care about when you get your ticket to heaven. So you can do so much more. But more importantly, let's think about this. What if taxes go from 10 to 20%? What would be the effect here? You know what? They might be looking at $20,000 a year in taxes. Over here, you might be looking at $2,000 a year. Which is easier to deal with? What's going to be more disruptive when it comes to your income? So I'd encourage you to put together a plan to slowly but surely put yourself in a position where you pay the least amount of taxes for the rest of your life. Because the reality, it'll make a big difference. Now, most importantly, make sure that it doesn't adversely affect you when it comes to your retirement income, your overall assets for the need for lifetime income, adversely affect the ability to cover a medical emergency such as long-term care help. I just want to put that out there because some people get really excited about reducing their taxes, but they don't understand the overall effect long-term, and you got to look at that. Okay, so now, why do I have estate planning up here? Well, most people don't realize estate planning is one of the most crucial elements of a holistic financial plan. But they also don't realize how it can affect them while they're alive. Now, besides having a trust, I'm going to show you a large number of different entities. Now, let's talk about this for a second. I have clients that are looking to leave California. They want to sell a business, okay? And you know what? For example, one client just recently, they've just recently moved from California, but what they did is they sold a rental property that they had for 40 years. After it's all said and done, their gross gains were going to be $1 million. But once their CPA told them that they were going to net $620,000, they started talking to me. They agreed with my recommendation and utilized this little one right here. You see it says CRAT, affectionately known as a CRAT. And what we did is that we had a very skilled attorney write a charitable remainder annuity trust. And what we did is we put that property into that charitable remainder annuity trust. 10% of that asset, or $100,000, was going to go off to the charity when they passed away. They had to pay $5,000 for a trust, another $5,000 for a CPA to do the charitable remainder annuity trust tax returns, and then they had additional little expenses. But at the end of the day, when all's said and done, they received 5 tax-free distributions totaling $880,000. So that means instead of receiving $620,000 by paying all their taxes, they were able to realize an extra $260,000. There's other things that you can do. There's trust that will enable you to defer taxes for your whole life and your kid's life for up to 150 years. There's other trust or structures that will enable you to defer taxes for 30 years. I have a client, they're farmers, they're potato farmers, and with farming, they give all their produce to a transfer house that makes a little bit, and they already have contracts to sell the potatoes. The problem was is this transfer house, unbeknownst to them, went bankrupt. All their potatoes spoiled. So all the revenue they were expecting to receive was gone, but their debt was too high. And the bank came back to them and says, hey, you're going to have to reduce your debt. And they decided they needed to sell something. But they started selling farmland that they've had for decades. And you know what? The taxes on it was $980,000. So what we did is we utilized a structure called a monetized installment sale, where they were able to sell it, receive the proceeds tax-free now, and have the taxes deferred for 30 years. Now, after paying off their debt, which was significant, they ended up with about $200,000. They saved that $200,000 and put it in an account that would average about 7.5%. So in 30 years, they'd have more than $1 million to pay the taxes. What it did allow them to do is continue farming their other lands and continue on with their life without serious disruption, because if they didn't utilize that, they would have had to come up with almost another $1 million, sell more land to take care of Uncle Sam. So what I'm trying to do is say, hey, there's a lot of things available when it comes to tax planning. You just want to see what's available to you. Now, I know I talked about a discovery session, but I also want to give you something that I think is really important. It's not an offer. If you go into the question section and write the word overtaxed, we will see your name, and since you're part of this, we have your email. We will email you a download of this book called Overtaxed. It's 6 powerful tax-free investment strategies and how to use them. This is a bestseller written by Ali Hashimian. It's a wonderful, wonderful, wonderful book. I recommend everybody utilize it. Now, before I close this out and start answering people's questions, I just want to put one thing back up on the screen. Retire Smart asked me to be available to help people on the call, and we're calling it a discovery call. 5, 10, 15 minutes. Basically, what we're going to do is answer your questions, provide you some clarity, and show you how to use what or apply what we've learned to your own personal situation. You can see the link on there, but you can also go to the Facebook page as well as the Retire Smart magazine page, and you can see that link. So, whoops, what happened there? Let's see, let's go back to this. So what I'd like to do is just go in and look at some of the questions. If somebody has some questions here, I would love to answer them. Let me take a look. Let's see. All right. Okay, we have one person by the, what I'm going to do, there's a question by Veronica. Veronica, let's take a look at this question and see what it means to you. So, is it okay to withdraw on and off from my retirement money? First of all, the CARES Act will allow you to withdraw up to $100,000 without any pre-withdrawal penalties, okay, because of COVID-19. You will have 3 years to either pay all the money back and not pay the taxes, or include it in your income on your tax statement. And what that means is you could say, I'm going to pay taxes on $20,000 this year, $50,000 next year, $40,000 next year. You can do that, okay? So is it okay to do that? I would recommend this. Make sure that you use lower tax accounts, lower producing accounts. So that means if you have CDs or savings accounts, I would utilize those first before going into the retirement accounts. Why? Because 1, you're going to pay less in taxes, and 2, it's going to cost you less in interest. Okay? If after this is over, they're going to go back to the old rules, which say, hey, if you take a withdrawal from your 401k or IRA prior to the age of 59 and a half, there will be an additional 10% tax penalty on top of the taxes you had paid on all the withdrawals you make. Now, if you're in retirement, it's okay to continue taking from that. You just want to make sure it's within your budget, and you're obviously looking at the long term to ensure that it fits for you long term so that you don't run out of money. So let's see if we can find another question here. Okay. Okay, I just, there's an additional question. that just came in. I'd like to just go over it real quick. And that question is this. The gentleman has a rental property. He's about to retire. Kids don't want it. Kids don't want it. He's tired of taxes, or not taxes, but it looks like trash, toilets, and the tenants. Okay, probably doesn't like Home Depot either. But he's wondering what he could do besides a 1031 exchange. For all of you on the call that don't know what a 1031 exchange is, if you have a rental property, the IRS will allow you to defer the taxes and the capital gain and the recapture depreciation, providing you acquire another rental property that is equal or greater value and has the same debt. Now, sir, there is an option. I talked about the charitable remainder annuity trust. You can utilize that. Again, you're probably going to end up with 80 to 90% of what you sell it for, maybe a little bit more, maybe a little bit less, depending upon your situation and the way you have the asset structured, but that's an option. Or you can use the charitable remainder annuity trust. I'm sorry, I already said that. The monetized installment sale, or you can use a Delaware statutory trust. The monetized installment sale will enable you to defer your taxes for 30 years. If that helps you, great. Or you can use the Delaware statutory trust. You want to make sure it's done properly. There's a lot of little things that go along with that one. But if it's done properly, you could be in a position where you can defer taxation and just pass it down from generation to generation for the next 50 years and only pay taxes on the money you spend. So, ladies and gentlemen, I don't see any more questions. I'm going to wait for about 20 or so seconds. If I see more, I will answer them. Other than that, I want to thank you all for joining us. Again, if you'd like to, get that discovery call, go to the Facebook Retire Smart Magazine, or go to the web page for Retire Smart Magazine and go ahead and sign up. I'll look forward to giving you a call. I will likely ask you to have your tax return available so we can actually do some profiling and show you what's possible. With that, I really don't see any more questions. I want to thank you all for joining us, and I wish you all safety and health. Bye-bye.